Good afternoon. It's now 3 o'clock. I think we are live, both for those who are present here with us in this fine meeting room and for those who are not present with us, wherever you are in the ether. My name is Robin Archibald. I'm the chairman of the company. It's my pleasure to welcome you to the annual general meeting of the company. And just to be clear, it's going to be followed by a separate general meeting at 4 p.m. It's now 3 p.m, time appointed for the AGM. First, let me give a rather lengthy explanation for how the meetings this afternoon will be conducted. For those of you who are attending on the online platform, the broadcast of the general meeting will automatically commence at 4 p.m. You will not need to log out to access the general meeting, and importantly, the AGM PIN, however you've used it, should be used for both meetings. Secondly, I'd like to introduce my fellow directors, Margaret Payne, who's the audit chair, Marianne Cordero, who's the chairman of REMCOM, and Patrick Reeve, who's known to many of you. And we have Will Fraser-Allen as the chief executive managing partner of Albion Capital. And Will's got the difficult job today of giving the presentation on the results of the company for the year ending 31st December 2021. The quorum for the AGM is 2 members. We have, I'm pleased to say, more than 2 members in the room and by webcast, and so I declare the meeting open. The notice convening the meeting has been in your hands for the statutory period, so I'll take the notice at the back of the accounts as read, unless anyone objects. Interesting, this is the first hybrid meeting of the company with attendance possible either in person or via our electronic facility. We've arranged the Lumi platform to broadcast both meetings so that members can participate live using the platform's software and to give as many members as possible the opportunity to participate. You will be able to ask questions and vote on the proposed AGM resolutions at the AGM, and questions on the management agreement at the general meeting and voting at the general meeting that follows at 4 p.m. So the formality is I now declare the poll open, both in the room and those who are online. Before we move on to Will's presentation, questions and the AGM resolutions, the next part is procedural. I have to go through it, so apologies. And if there are questions on it at the far end of how you vote, where you vote, and so on and so forth, we have company secretary and staff here who can answer it. The resolutions will all be voted on by way of a poll, taking consideration votes already received by proxy, and we have helpfully received a number of proxy, well, quite a high number of proxy votes, and corroborated by the registrar. If you're participating by the Lumi platform, the list of resolutions will automatically appear on your screen. Please select the option that corresponds with how you wish to vote. Once you have selected your vote, the option will change colour apparently. We don't have any sight of this here, but it'll change colour. And a confirmation will be sent to indicate your vote has been cast and received. There is no submit button to vote on all the resolutions displayed. Select the vote all option at the top of the screen. I hope that's reasonably clear. If you want to change your vote, reselect your choice. To cancel your vote, select the cancel button. You can vote and change your vote if required at any time whilst the poll remains open and before I announce its closure, which will be at the end of the meeting. So there's plenty of time. But if on the other hand, you have already voted, then there's no requirement unless you want to change your vote to vote again. Those members, pleased to see you all today here in the room, can use the poll cards handed out by the registrar, which I hope you have received. Excellent. Let me just stress again that if you have already completed and submitted a proxy prior to the meeting, you don't need to vote again on the poll unless you wish to change your vote. If you're using a poll card and don't know the number of ordinary shares which you hold and you want to cast your vote in the same way in respect of your entire shareholding, you may leave the number blank. It will be checked against the register by Computershare, the registrar. On the poll card, for those who are present, could you write your name in block capitals on the card, including, if applicable, the names of all joint holders. In the voting sections, mark the appropriate box with an X, state if you're voting as a proxy, and sign the form. Pause for breath. Once you have completed the card, please return it to the registrars for verification against the register and for the recording of the total votes at the end of the general meeting. Quite important, this part. Just to remind you, you have 3 options for each resolution, and the same is true for the other resolution at the general meeting. You can vote for the resolution, against the resolution, or you may withhold your vote. Are there any questions on the voting procedure? I hope not, but we do have our company secretary here if they can manage to work out how on earth this is all done electronically. I'm just checking with Lumi, anything coming through there? Good, so you've all followed the procedure. I'm glad I returned my proxy. Now to the main business of the meeting. Following the manager's presentation, the directors and managers are happy to answer questions from members about the presentation or the proposed AGM resolutions as time permits. I'd like to thank those members who have already submitted their questions and queries through the chairman email address, and over the preceding weeks, funnily enough, we've been answering some of the questions that have come through. If you're participating via the Lumi platform and wish to ask questions, and I see there's some coming in here, there's even votes for you. Well, it's the UK entry at the Eurovision by the look of things. There's you can vote through Lumi and wish to ask questions on it. Please select the messaging icon from within the navigation bar and type your questions at the top of the screen. To submit your question, click on the arrow icon to the right of the text box. Now, as far as practical, the Q&A section will be dealt with first from those who are in the audience here, and we see your hands going up, you've got a question to ask, and then as far as we can with the webcast attendees on any questions that are submitted. Depending on the level of questions, there may be not sufficient time today to address all questions raised, but please be assured that all relevant questions and their corresponding answers will be responded to and posted on the Albion website as appropriate. Right, now on to the important bits. I'll now hand over to Will Fraser Allen for his presentation before we come back to the formal business of the meeting. Thank you, Will.
Robin, thank you very much. And a big welcome to everybody in the room and those that are watching online. So it's great to be able to host a hybrid meeting, to be able to speak to both physically and virtually. So huge welcome. I'm going to now present the results for last year to 31st December 2021. I'm keen to cover the sort of broad background of the world that we live in to the extent I can give some thoughts, but importantly looking at how the fund has performed over that 12-month period, looking particularly around the investment portfolio, new investments we've made, investments we've realised, looking at the all-important ESG, and equally important, giving you the details of the proposed change in managers' remuneration that has been put forward by the board for your vote. At the end, my final slide will give a view on prospects, and I'll also briefly touch on the quarterly results that have been announced just before the meeting, covering the period to the end of March. So 2021 was a strong year, in fact, a very pleasing year, ending with a net asset value of just over 80p, but importantly, delivering a return of just under 15p for the year. So that's a movement in shareholder value of some 21% in a year, reflecting a strong year for both the portfolio, but also valuations being ascribed to the types of businesses in which we invest. More of that to come. We were able to pay a dividend in line with policy of 3.68p, and by way of reminder, our policy with regard to dividends is to target around about 5% of NAV, and that's calculated each half year as 2.5% of the prevailing NAV. We live in very strange times. It will not be lost on any of you in this room, or indeed on watching from afar. The events in Ukraine are pretty awful, to put it mildly, and to come so soon after the COVID pandemic, really it does make life quite difficult for many at a very personal level, but it also makes it challenging for those of us that are looking to invest your money. Lots of uncertainty on almost every level. Inflation rising very fast on the back of very high energy costs, and as a result of that, very high food costs, and a real dilemma for those setting interest rates. On the one hand, worrying about extremely high inflation, and on the other hand, wondering whether raising interest rates is the right way to do it, or are we simply hurtling towards a recession. Inevitably, one has to be considerably more cautious in our outlook than we would have been this time last year. But against that, we can take some comfort from the way our portfolio has been designed. Importantly, the focus, particularly of investments in recent times, has been on mission critical products and services. So particularly in software, mission critical software being used by large enterprise clients. So that has very much been designed to give us some resilience in these more challenging times. If we look at the track record over a longer period, the 21% for the last 12 months we've talked about, but actually when you look back over 5 years, 52.63%, so that's over 10% a year, and looking over a longer period of 10 years, which it's just under 8% per year. Importantly, well ahead of our target, which is to deliver a 5% yield and then growth above that. So looking at the year as a whole, what have been the highlights? The board has taken a decision to build the fund, the scale of the fund. So we were able to raise 21 million as part of the Albion top-up offers, which in themselves raised just under 100 million. And that was up on last year. It comes at a time when we've got a portfolio where the companies are growing very fast, have got ambitious business plans, and are looking to us as investors to further fund them as they build out those business plans and as they grow and develop. In terms of exits, quieter than the previous year, but I'll go through a couple of the more significant ones in a moment. Investment has continued a little bit down on the prior year, more timing than more than anything, and that was both into 5 new companies, but also supporting our existing portfolio. And as you'll see, the amount going into the existing portfolio was the greater of the two, and that very much reflects our strategy that we invest in the business in a limited way in the early days, and then as that company's business plan develops and they grow, we further fund that growth over time. Share buybacks broadly in line with the increase in the size of the fund, and dividends were in line with the 5%. The reason why in absolute terms it was rather less than the previous year reflects that in the previous year, as you will recall, we paid a 9p special dividend. Digging into the key drivers of growth in the year, we enjoyed particular growth in some of the larger companies' portfolio. Quantexa being our largest company, and I'll talk to that on a separate slide. But following a very successful external fundraising, we saw a very significant uplift, delivering some 9 million of value to the fund. Credit Kudos hadn't exited at the year end, but in prospect of that exit, we wrote it up, and Credit Kudos sale to Apple was recently completed, delivering a very good return for the fund. Aviva is one of our digital health businesses treating diabetics, as it also saw an uplift on a third party fundraising, and a substantial fundraising at that. Inevitably in a venture portfolio, you also have those businesses, those investments that don't go to plan. And the most significant of that was a business called Cancellation, which is an insurtech business which struggled to grow and to sell in an increasingly hardening insurance market in an industry which always takes considerable time to adopt new technology. So we've taken a very cautious approach here and written it down. That's not to say we don't think it can recover, But I think at this stage, until some of the turnaround actions that have been taken start coming to fruition, it makes sense to be cautious in our valuation. There's a number of other ups and downs, and rather than try and list them here, they're detailed in the annual report, but they tend to be relatively small. But in aggregate, it was an upward valuation of 12 million and a decline of 3.6. So how's the portfolio developing? And to remind those of you that have been to previous AGMs, the strategy has been over recent years is that, as in line with the changes to the VCT rules, we've been looking to reduce our exposure to the old asset-based strategy, and reinvesting those proceeds into innovative and growing companies with this particular focus on software and healthcare. And we've made a lot of progress in that regard. So as you can see, if we take software in its aggregate, and that's we've now got some 46% of the portfolio is now invested in software, and then healthcare representing another 19%. Our renewable energy portfolio, which is a long-term income generating hold, sits at about 10%, and that has declined as those assets effectively generate cash, but also to reflect the fact that the fund has grown, and therefore the relative size of renewable energy has fallen in line with that growth. Elsewhere, we've got some schools, which falls into education, which are performing well, particularly our school, Radnor House in Sevenoaks. Looking at the portfolio in a slightly different way, this is really how we measure that we have got a portfolio that is diversified by stage of company, early stage through to more advanced, therefore less volatile. And we look at that in terms of revenue, and we look at that in terms of employees. There's a proxy for where they are in those under those two bits. So it's really just making sure that the early stage element of our portfolio is manageable, but recognizing that it's extremely important, because it's those companies that, by investing in them as they succeed, form the larger, the more stable investments in due course. And again, a lot of progress this year, reflecting a movement of growth across portfolio, particularly in some of the larger ones. So in terms of revenue, and I define an early stage company as less than £1 million revenue, that's sitting at about 12%, which is compared to 24% last year. And if you look at it in terms of employees, so less than 20 employees being a very small business, that's right down to 4%. You know, this will change over time depending on how the portfolio is made up. So if you had a very large exit, invariably that would increase. But at those sort of levels, that feels very comfortable in terms of a risk profile of the overall portfolio. And what's very encouraging is when you look at the other end of the scale, so those that are scale up, revenues over 5 million, that's now 60% of the portfolio. So a very significant chunk of your portfolio is in our world, and the larger, the more stable businesses. But important to note, and these are still small companies, but they grow very fast. Our strategy, an important strategy in venture capital, is that when you do have winners, that you continue to back those winners as they grow. And as a result of that, success will equal greater concentration at the top end of your portfolio as you harvest that growth. And bear in mind, that's an important compensation for those that won't succeed. The other side of venture is that not everything can work. You know, we are at the higher risk end of investment. But I'm encouraged by this slide, because the top 3 companies have moved forward as significant in the year as we discussed earlier, and they now represent a book value of 28 million in this portfolio, which is some 26% of the overall NAV. That was the NAV at December. As those of you that will have seen the December results that have just been published earlier today, that will clearly come down given the increase in the size of the fund. But this slide is important, because these these three businesses represent a potential significant upside for us. And I'm very pleased to say that they're doing very well. So Quantex are providing a very critical data analytics platform that is used in some of the largest global banks in the world, and they use it specifically to detect financial crime. Financial crime doesn't go away in any environment, and it, in fact, increases every year. So that's a business now that has seen revenue growth of 30 times since we invested. It's now employing just under 500 people. It's based in many offices around the world. Radnor House is our school, the one in Seven Oaks. That's had a really has had a successful bounce back since the pandemic. Student roll is increasing, but the real opportunity is the fact that that school is got some way to go before it reaches full capacity. So the capital upside comes very simply from the student roll as more pupils can be recruited, and that particular site has capacity for some 700 pupils when full. And then finally, Aviva, this was the business that's selling effectively through a software platform. It's providing dietitian services, particularly in support of the treatment of type 2 diabetes, become widely used by the NHS, particularly in a world where many of the healthcare systems are recognizing the importance of technology to deliver their services in a more digital and efficient way. And as well as the NHS, this is operating in France, in Germany, and in Switzerland. So we're creating a European category leading business in the treatment of diabetes. Important that we're making new investments on lots of levels. It's important that we are contributing to the UK recovery by backing those young innovative companies that can grow very rapidly and can therefore create value through the technologies that they develop, but also through the increased employment of people at a time when we're looking for highly skilled jobs as a way forward out of this pandemic and the difficult times we're in. I'll pick up on some of these on Gravity and Nouveau Air in a bit more detail in a moment. Solidatus is a good example of our investment strategy looking at the management of data. And this is, again, selling into the banks, and it's helping banks comply with all the very complex data regulation, which is multi-jurisdictional across the globe. And this platform helps a bank ensure compliance across many offices, many territories. And then Bright Light on the far right is very much on the early stage. It's a very early stage investment. And this is using GPUs, graphics processing units, as a way of processing data through databases. So effectively a GPU allows you to process data far more quickly and effectively. Looking at a couple in a bit more detail, Gravity very much in our B2B software area. So this is about managing how software talks to each other. So with this proliferation of many software platforms, enterprises need to be able to manage how all those different platforms speak to each other, and that's what an API effectively does. And this is a new generation, a new way of looking at how you can effectively mesh together lots of different elements of software. It's growing very fast. We put in £4 million as part of a larger round, and that's very much all around, as often the case, companies using that money to expand overseas to the US in this case, but also importantly developing that product so it continues to be market leading and can disrupt the current incumbents in the market. Nouveau Air, very much in our health tech strategy. We like healthcare, lots of long-term growth, but also more importantly, the move to the provision of healthcare, the provision of digital health has been such a big theme, massively accelerated by the COVID pandemic, as many of you will have been aware, in terms of those that have had to access the healthcare system. That's not going to go away, as the benefits are well recognised, and Nouveau Air does this, as I alluded to earlier, through providing the advice and treatment by dietitians, particularly in type 2 diabetes. So a huge problem for many countries, the UK in particular, with the growth of obesity and therefore growth in type 2 diabetes. So being able to have regular engagement with those patients through their mobile phones, which is effectively how it's delivered, is showing extremely effective results relative to infrequent and occasional visits to clinics. And it is very much where the world will continue to move. Follow-on investments, very important part of our investment strategy. So making sure we back those winners, making sure that we provide the fuel for this growth as these companies scale. And in that vein, we've got. So I've just realised I gave you a completely wrong background to Nouveau Air. Nouveau, I was thinking of a completely different company, for which I apologise. So Nouveau Air is actually much more about respiratory disease. So this is, again, it is a platform, it is a digital platform, but it's treating those particularly cystic fibrosis sufferers using a spirometer, which is connected up to their mobile phones. And that is, again, working with the NHS, but also working particularly in Scandinavia. Aviva, of course, being on this slide, so I won't put you through Aviva again, but that's again an important part of our digital health platform. Elliptic is an interesting one because it's in quite a volatile sector at the moment, providing money laundering services to the crypto assets. So could be cryptocurrencies or other assets. And effectively what this is doing is it's allowing more mainstream financial institutions, so be it banks, who are now being put under pressure to provide, for example, custodial services in crypto, but very much being required to show the same level of money laundering compliance that they would using traditional currencies. Clearly a very volatile space, but one that we cannot ignore, that despite the recent volatility is becoming an increasingly large asset class, and one that the large banks simply are unable to ignore. And then finally, Black Swan Data, a company that's been in our portfolio for some time, but has in more recent years become very focused on providing companies, FMCG companies in particular, i.e. those that are selling to consumers, and it provides them through a data analytics platform the ability to predict consumer behavior. So how do I know whether this idea for a new product is going to be a success? So this is used by the innovation departments of some of the largest FMCG companies in the world. Important in a portfolio that we have a regular flow of exits each year. So this is no longer a bit around day-to-day income being generated by our portfolio companies. What we're looking to do is grow capital value by growing the young companies in our portfolio and then taking them through to a successful exit, hopefully at a strategic price. NPP is a company that we sold recently, and this was all about helping enterprise companies manage their online subscribers. We invested 4 million, we made a return of 1.3 times. Nothing spectacular in the multiple, but an example that even the businesses that perhaps don't totally live up to the business plan can still be sold and realize value. And then finally, innovation broking, a small investment in this portfolio, but an example of some of the source of returns. This wasn't particularly a technology business, it was actually an insurance broker. But what we did there was we set up pretty well from scratch a new insurance broker that was focused on technology and life sciences companies in particular, that we built up at a time when there's been a wall of private equity money looking to consolidate that sector. And as you can see, we were able to deliver a 10 times equity return on our investment, this particular fund being a relatively small element of it, but nice to have that sort of multiple within one of our exits. So strategy, putting all that together, looking to invest in companies potentially very early, that's seed, but also looking right the way through to Series B, where companies could potentially have up to 100 employees. Where we're finding the greatest success is backing those young seed ones. And as I've said a couple of times already, then having the confidence to continue to back those ones that are succeeding as they grow, and being in a position to still be a significant shareholder in those companies like Quantexa when they're starting to get really quite sizable, and where some very significant external money is coming into those companies to grow them even further. It's about long-term trends, the digitalization of the economy and of large enterprise being clearly an enormous theme, healthcare being an enormous theme, and having the benefit of permanent capital, because these are evergreen funds, and therefore being able to take long-term views, both in terms of the sectors, but in terms of those companies in which we back. But it is about business to business. We don't look to invest in consumer facing businesses. We want to get away from the ups and downs, the cycles of consumer spending, looking instead to sell to large corporates and hopefully and typically mission critical software that they will continue to need to buy even in more difficult times. And life is going to become more difficult. So software, healthcare, but also looking at other areas, and I list a few of the areas: automotive technologies and sensors. ESG has become increasingly important to everybody, and absolutely rightly so. We've always believed that there is real value in backing companies that have positive societal and environmental impact. So this absolutely fits with our DNA. But what is great about the focus that is now being placed on this is that it's better reported, and the systems to ensure that it happens are now being put in place by much of the investment community. And we are, whilst no means alone on that, I believe we're making some really good progress relative to our immediate peer group. So this is all about making sure that the way we invest develops companies with long-term sustainable value, and it's about making sure that we integrate ESG in all our investment processes. And that's whether we are, when we're screening, when we're looking at the companies, making sure the companies, by what they do, fit with our ESG values. But it's then making sure that as part of our due diligence, when we look at those companies, we are collecting data about where they are in their ESG strategy, recognizing that they'll all be either at different stages in this, but capturing the data where they are at the beginning of the journey. And then whilst we're in the very privileged position of being involved with those companies, almost always at board level, encouraging those companies to develop their ESG strategy, measure the outcome of that, both because it will create long-term value through sustainability, but it's also an important part of preparing those companies for their exit, because we ultimately will be selling to typically large global technology businesses, which themselves will have very sophisticated ESG strategies. And if they were to IPO, they will be looking to raise money from investors who, like us, have very deep held ESG beliefs and requirements. But it's not just about our investing companies. We at Albion are working very hard on our own ESG strategies. So we're looking at the carbon footprint of what we do and how we can reduce it. And to the extent that we aren't able to reduce it to zero in the short to medium term, we're backing biochar carbon removal offsets. This is effectively putting carbon into charcoal to balance our own carbon footprint. But we're also looking more broadly than just what we can do in terms of carbon removal. We're looking at our own business in terms of diversity, trying to bring a broader group of people into our own business on the basis of a more diverse group sitting around the table. We'll make better decisions and we'll invest in a broader range of companies. So we are signatories to the Investing in Women Code. So that's all about us working to increase the number of women founders that we're backing, and very importantly, monitoring and measuring ourselves against targets. So ESG is very much part of what we're doing. We report to the boards on this. We report to you as shareholders, as you will see in your annual reports. And what I'm hoping is, as each year that I come back to report to you, there will be more that we can talk about in terms of the collecting the data and reporting back, and the success that we and our portfolio companies are having as we all look at how we can better live in the world around us. I just want to touch now on the subject of the general meeting, which will follow this. And the core to this is a proposal that the board are putting forward today, that they've put to us and is now going to you as shareholders. And it's made up of two elements. It's made up of a desire by the board to reduce the fixed remuneration paid to us as management fee, but balancing that with a performance incentive fee, which is designed to align our interests with you. So if I turn to the detail on the reduction in our management fee, the absolute fee has been reduced from 2.5% to 2%, and that will be backdated, if approved today, that will be backdated to the beginning of January. And effectively separating the management fee away from the administration fee. So I just noticed a mistake on this slide. The 0.2% is an administration fee rather than management fee. And what that is aimed to do is that covers everything other than the investment activities. So that's everything around producing financial statements, managing all the third-party relationships. And that's been set as a notional 0.2% of NAV. But importantly, it's been capped at 200,000. So as you will have seen from today's announcement, the fund is now well over 100 million. So that is now a capped fee, and it's also got a collar that it wouldn't go below 50,000. So effectively, as the fund gets larger, the impact of the administration fee becomes less and less. We've based on the December NAV. That represents an annual fee saving to you as shareholders of £250,000, which clearly adds up over time. And in fact, given the increase of the NAV post our fundraising, that will already be significantly more. But the balance to that is the board wanted to relook at the performance incentive fee and put in something that they considered appropriate to the type of investing we're doing now and the market in which we're operating. So if we look at the sort of principles behind a performance incentive fee, most importantly from the manager's perspective, is we are operating in an extremely competitive market for venture capital professionals. It is fundamental to delivering good investment returns to you is that I'm able to build, and I believe I have built, a very high quality investment team, and then making sure that we can retain them. And in line with the venture capital industry generally, an important part of that retention strategy is to share a performance fee amongst your team, so that they are very aligned to deliver outperformance. And that's an important point about this. That it's all about rewarding outperformance, and I'll come back to that in a moment. As you will hear from Robin shortly, the board went through a benchmarking process where they looked right across the VCT industry to ensure the proposal was appropriate in the context of the industry. And the key is that it was recognising that the existing scheme was no longer fit for purpose. It was complex, and it related to a capital structure that simply that no longer exists following the many years of raising top-up fundraising since. And then an important part of that is setting the performance hurdle. So looking at it in a bit more detail, the hurdle's been set. So this is what we've got to deliver before there's any return to us under this performance fees. And the board have set that at 5% per annum. And that is designed to be in line with the dividend yield of the fund, which is also 5%. So symmetry between the two. In terms of how we're rewarded, is a 15% share of that outperformance over and above 5%. And this is the way it's calculated, has been designed to deliver a smoother return. So effectively, it looks at a 5-year rolling average, and that's designed so that that any 1 year doesn't overly influence a payment, and you get a smoothing effect by looking at a 5-year period. And so in any 1 year, effectively, you're only being rewarded for 1/5 of that year's performance, and then the rest of it is on performances in the previous 4 years. So you should get a smoother, less volatile payment, and that's very much in recognition that some of the return is based on unrealized valuations. The first period that is from January 19 to 23, and in looking at this, we've worked out that if this same scheme had been in place since 2013, what would the impact of that would have been? That an additional payment to Albion would have been pretty nominal in the context of a very long period of time of 47,000. But what is really important is within that total payment, getting on a very significant chunk is now directly linked to performance and isn't a fixed fee based on NAV. So looking forward, well, this is a very difficult slide this year. I think many of us in the investment industry are looking at what's going on around us and trying to form a view at a time when we live in incredibly uncertain times. The good thing is that we have a strategy in place that was always designed to be all weather. I do believe that by investing in mission critical products and services, we should have good pricing power in respect of inflation. But we do need to be conscious that we are investing in small companies. Importantly, the fund has a decent level of cash. We are in a good position to support our companies. They are very entrepreneurial, the management teams that run it, and what has been seen in difficult times before, that many companies, many of the very successful companies are born in times of adversity. So we look forward with caution. We believe in the strategy that we've got in place. We've got a very good pipeline of new companies. There's lots of interesting technologies appearing, but also very importantly, we've got a portfolio of companies that are still growing very fast and provide us with the opportunity to support those as they grow over time. Quickly, so we've just announced the results of 31st of March. So the NAV following dividend payments is 82.05p. Encouragingly, that represents an increase of 1.74% over the quarter. And that does reflect a quarter where many of these more volatile macro events are playing out. Just looking at our interaction with shareholders more generally, today, given that we were having a general meeting, we went for a hybrid approach. We have found virtual AGMs to be very successful. What we're finding is people are dialing in, and then also because they're recorded, we are seeing literally hundreds of shareholders engaging with those recordings. So on balance, the board, both for this VCT and the Albion VCTs generally, are keen to continue with virtual AGMs as a way to maximize engagement with shareholders. But we do like, and we do, both we and the board like engagement physically with shareholders. So as a result, we're very keen to continue with our popular annual shareholder seminars. And I very much encourage each and every one of you to come. We've now got the dates on the 23rd of November. It'll be held at the Royal College of Surgeons, which is in Lincoln Fields in London. I very much encourage people to reserve a place. And the details are on the slide here. So it's an email to info@albion.capital. We're going to do lots of, hopefully, some quite interesting sessions this year. And I know the board will join me in very much hoping that you'll join us so that we can re-engage again after these times of so much turmoil post COVID. So a dividend will be shortly in your hands on the 30th of June, and that was declared at 2.02p in line with our dividend policy. So that brings me to the end of my presentation, which I will hand over to Robin. So thank you very much for taking the time to listen to me. I hope it was useful. And now to Q&A.
Thank you. Thank you for that very comprehensive presentation. We're now going to invite questions. Now, can I just remind everybody, we'll take all the detailed questions insofar as they arise on the management fee part in the general meeting, which comes after 4 o'clock. So we can concentrate just now on those who are physically here and those who've very helpfully submitted quite a number of questions online. So if I can open up to questions on the AGM business and so forth, and I'll take one of the online ones first. The question, which incidentally ties in, Will, and it's for you, is you run high balances of cash. Why is that?
So I think there's cash in normal times and cash now. And if I take normal times first, in normal times, we have to balance the requirement for liquidity in our portfolio to the impacts that holding cash might have on investment performance. Fundamental to that analysis is the fact that we are managing a portfolio of very illiquid assets. These are unquoted companies. Our exits are driven by events that are not always in our control, in our influence, but not control. So we need to make sure that at any point in time we have sufficient liquidity to meet the requirements of the fund, and that is paying dividends. And we do, as shareholders have asked us, shareholders want regular, predictable income. So we need to ensure we can cover that. We need to have sufficient cash to support our existing portfolio. That is an increasing theme in the type of investment where we're backing high growth businesses. We need to ensure that we can support a share buyback facility, a very important service to those shareholders who wish to exit. And that becomes a balance, because the balance being that we need to have sufficient cash also to take advantage of opportunities that come our way in terms of new investments. So given that rather sort of complicated juggling act, it's important that we have a decent level of cash that we can manage all those calls in the context of an illiquid portfolio. If I look a bit more granularly at where we are today, we live in uncertain times. And with that, I think becomes the responsibility to make sure that we have resources available to further support our portfolio companies if indeed we find they need additional cash, because it may not be forthcoming from elsewhere. So I think where we sit today, a decent weight into cash, I think puts us in a strong position, and to me makes a lot of sense as a counterbalance to the uncertainty of the world around us.
Thank you. If I can turn to a question from the floor.
I haven't done my research fully, but I do.
Can I just get the mic so that we pick it up on the system? Sorry about that. Thank you.
Sorry, I'll start again. I haven't done my research fully, but I wanted to make a couple of observations and then get your comment. The three investments that you referred to in the fund are also in the top 5 of 2 other funds, and all of the new investments you described were all multi-VCT investments. So as a long-term shareholder and multiple round investor, I don't understand the differentiation of this VCT versus the other VCTs and how that is evolving over time, because it appears to be evolving to a more generic element. And which leads to a follow-on question, which is, at what point do you then, if my assumption is correct, at what point do you then go more radical and start considering merging some of the VCTs for as other VCTs have done over the last 5 years?
Thank you very much. Good questions, and we can take them in turn. And I'll hand across to Will, because even for those of us who joined the board quite a number of years ago, that first instinct, are we a common stable? It took a little while to get our heads around. But Will, can you explain how the stable works? Most of which was all launched at different times, so the cash would have come in and so forth. So how the stable works and the co-allocation.
So absolutely, and I think I had to start with a bit of a history lesson because there is a journey that we've gone through to where we've ended up with 6 funds, and each VCT has a different story. But if I pick out some of the themes, you know, we had VCTs that were launched with different investment strategies when the VCT rules gave you a broader range of investments. So we had one fund that was very focused on asset-based investments. We had another fund, like this one being an example, that was launched in 2000 with more of a technology flavour. So originally, within the Albion stable, it was the different funds were differentiated by investment strategy. We also have added funds to our stables, and this is for those that are familiar with King's Arms Yard and Crown Place. These were funds that we took over at the request of boards from other managers, where we've gone through a process of realising portfolios to then reinvest the proceeds in our broader strategy. So that's why you started off having lots of different funds, all doing different things. Some that we've raised ourselves, some that we bought in. What has then happened is 2 things. Really, the VCT rules have changed to be much more focused, and you know, for good reason. It has been government policy that VCTs should be backing innovation and growth, and rightly so. There is a very generous tax break that the US new investors benefit from, and the quid pro quo of that is because you're being compensated for the risk of backing those young companies that can grow into the huge value of the UK economy. But within that sort of government direction, we as a house have become increasingly interested in technology, and actually we are very comfortable in that world. So actually it's been a happy marriage of government policy and our own interests. So where we're going to now is the strategy that I've outlined is now a common strategy across all 6, but there are still differences across the six funds, and the biggest difference is the weighting to different investments. So if we look at this slide. That not all the weighting that this kind of has to these slides varies in all the other funds. So to your question, well, why don't you merge them all? I think the biggest challenge to that, and it's not that we don't continually look at it when asked to, and generally by boards, but I think the problem you will always have is when you're looking at an individual weightings against another, there will always be still quite a significant mismatch. And that's likely to continue because when we invest in new investments, the stake that each fund takes of that investment is dictated by the amount of cash they have. So we're always going to get this ongoing different weightings to different investments. And when you get, increasingly as you get larger, more concentrated investments, that weighting becomes more and more important. So if you're to put it in very simple terms, if you're in a fund which has got a very, very low weighting to Quantexa, as opposed to another fund that's got a very high one, and it is your view that that's a star in the portfolio, that there is a mismatch between those two sets of shareholders if you were trying to merge their interests. And that's the challenge. I think the other important point, and we did go through, as reported by Albion Venture Capital Trust last year, we did go through a detailed strategic review, looking at what they were going to do after they sold their care homes, which was a big chunk of their portfolio. And I think one of the other points that came out of that review is that actually because these funds are all now quite substantial, and this fund is now well over 100 million, actually the savings you make from a merger actually aren't that significant, because the cost of the merger is very expensive. The actual saving beyond a small amount of directors' fees isn't very much. So it is several years to pay it back, to the point where it becomes quite a difficult decision as to why shareholders are being asked to pay those costs for limited savings down the line. And the analysis almost becomes, well, why are we doing this?
Just to pick up on the point, we do ask this fairly regularly as a board, because none of us sit here looking for continuation of a company if there's a much larger economy of scale. But there's substantial costs of stamp duty, for example, on quite a proportion of the portfolio, particularly now as equities dominate rather than bonds, which are less stampable. A Section 110 scheme, which would be merging two companies, which has been done before, because in fact, some of us are sitting here today as a result of a merger done some 9 years ago, or almost 9 years ago. But you're talking middle hundreds of thousands of pounds involved, and active participation from shareholders, because these are complicated schemes. So all the questions that we've asked over the years has given us the economy answer that we're economic as we currently are. But again, it drives us partly to what we're going to be talking about in a few minutes' time, about how we've tried to address it in terms of fees. Now, if that's satisfactory for that, good. Can I now go into
great question.
Very technical question, but gosh, this was possibly addressed either to Margaret or me. On the director's report on page 51, the graph assumes that dividends were reinvested at the share price of the company at the times where share quoted ex-dividend. Why isn't the share price at the time the dividends were paid being a result that the typical investor could achieve? Now, there's one. That's a train spotter's one. Well done, going to page 51, which is part of the remuneration report. The remuneration report requires us to give, it's effectively a statutory disclosure showing how the FTSE has performed and how we have performed. And this is part of the equation connected to directors' remuneration. But to answer the narrow technical point, the AIC Statistics Committee requires that calculation of total return to be done for us or any other investment company, which is a different total return calculation, incidentally, from the one that we do, where we look at the aggregation of our asset growth plus the payment of dividends. So we're entirely in accordance with the grand AIC, of which we're a member. Is the answer to that particular point. Anything else from the floor here? Yes.
One of the exits was at 1.3 times. Now, unless we were thinking that at least we're not selling it at a loss, was there any chance of any milestone payments? Did you consider like maybe getting something if the thing does well with the new owners?
So you're right. To thank for that question. You're right. Often one does add milestone. The reason I put that slide up there was to demonstrate that even a business that didn't particularly perform under us can still have value. So absolutely accept the point that 1.3 times is not a particularly exciting investment. In that particular case, there wasn't any further earn-out. Actually, we benefited from the way we had made the investment. So it wasn't put up so much to say it was a great return. It was a demonstration that even when things don't go quite to plan, there is often some form of liquidity in form of it. It really reflects a year where we didn't have a particularly busy exit. By way of observation, if you look at today's quarterly statement, you'll see 3 very strong exits, which has delivered which has helped us to mitigate some of the downward pressures of technology valuations.
Now, in order to share the load, because you've been under the pummel for a little bit, I'm going to ask Patrick to take the next question. And the question has come online: to what extent have the green energy companies benefited from the increases in electricity prices? And is this reflected in their valuation? Now, I introduced Patrick at this point because he's non-independent on this board, but is instrumental on the valuation committee, and because of his prior knowledge of all that goes on within Albion, is a fundamental part of our board when it comes to valuations and so forth. Does that give you thinking time, Patrick?
Thank you. Yeah, no, that's great. Thank you, Robin. So the valuations of the renewables they have sort of 4 separate components really. They've got income from electricity prices. They've got income from subsidies. They've got a finite life, which is reducing year on year. And so, for instance, some of our solar assets are now getting down to the sort of low teens in terms of years. And then they've got a discount rate. And the discount rate is what sort of valuation these actually have in the market for those sort of cash flows. And that discount rate is given to us by a third party, PwC, so it's a third party assessment of that discount rate. So yes, on the one hand, most of these assets, not all of them, because some of them are on extremely long terms, and you've got 1 or 2 freeholds, but most of these are on quite sharply declining lives. But at the same time, the discount rates have been falling, and also the picture of the net present value of the cash flows has been improved by higher than expected electricity prices. So it's all taken into account. This year we saw a little bit of a rise in values. normally where we are now would see a gradual decline, but from assets that are also strongly cash generative. So I hope that helps you.
There's a quick single follow-on question, which I think you probably answered, which was whether the valuation takes into account depreciation of underlying assets.
Which it does, because of the long-term cash flows which are declining.
Now, as we're reaching 4 o'clock, I don't want to curtail questions, and it's very helpful to have had that number of questions, both virtually and from the floor. Can I move on at this point to summarise the resolutions and move on towards the end of this formal session? So, continuing the formal business of the AGM, the full text of each of the resolutions is set out at the end of the notice of the meeting. And as you're aware from the accounts, that we are recommending as a board that all the members vote in favour of the resolutions. I'll draw a deep breath to cover all the resolutions, which are: the first is to receive and adopt the company's accounts for the year ended 31 December 2021, together with a strategic report and the reports of the directors and auditors. And that's an ordinary resolution. The second resolution is to approve the directors' remuneration report for the year ended 31 December 2021. The third, oh goodness, that's my own re-election as director of the company. Previously, I'd had somebody else put that one forward, but nonetheless, it's there under poll. The fourth resolution is the re-election of Margaret as a director of the company. The fifth is for re-election of Marianne. The sixth is the re-election of Patrick. The seventh is the reappointment of BDO as auditor of the company from the conclusion of this meeting through to when the accounts are laid. And the eighth is connected to that again in authorising us to fix the auditor's remuneration. The ninth, and I think we're getting into special resolutions now, is to consider how to allow us to allot shares. This is blatantly business that we cover every year, as you'll appreciate. The 10th is a special resolution which will give the directors the power to disapply preemption rights, which is what we use during the top-up offers. The penultimate resolution, which again is a special resolution, is to authorise the company to make one or more market purchases or share buyback of ordinary shares in the capital of the company. And the final resolution, which is of this year, is a special resolution for the cancellation of the share premium and capital redemption reserve, which gives us more capacity to use our reserves for purposes of, for example, share buyback. The results of the voting, some of which is coming to us virtually, some of it's coming from us here, the poll cards, some of it's coming through the proxy cards, will be announced after the meeting through a regulatory announcement service and published on Albion's website. So I can now formally confirm that the poll voting has concluded, and I declare the poll closed. In this screen behind me, and there, we will show you the current proxy votes that have been received by the registrar. And as you will note from that, on quite a high turnout in number terms of people who've chosen and helpfully to vote for us, that the resolutions are all comfortably passing. So we've just about reached the time for the next meeting. And if that has taken us through the annual general meeting, I can thank you and conclusion of the formal business of the AGM. Right, so